a way that is sustainable over the long run? And I think the answer is that we can do this, but we can only do this by focusing our institutional reforms on limiting fragility, or to borrow from an even bigger gadfly than I am, Nicholas Nassim Taleb, by making these institutions less fragile or even anti-fragile, so that when bad things happen within the context of the rules, we can absorb the shock without having to change the policy-making framework. Now, this idea of anti-fragility in the context of European institutional reform would represent a significant departure, even from the proposals that Jose Maria Barroso unleashed 2 days ago, proposals that actually look very conventional in terms of reestablishing rules, reasserting the importance of enforcement, and then adding only a very little bit onto that, much of which I believe will be politically impossible to achieve in terms of establishing buffers or stabilization funds that will allow us to bail out governments that get into trouble. So if we buy the argument that I'm going to make, we're going to have to embrace a very different institutional reform proposal at the European level. In embracing that very different institutional reform proposal, we're going to have to get a better sense of the limits and possibilities of European integration as a whole. Now, this argument, I think, fits well within the context of this broader seminar because it's an argument that applies not just to life within the single currency, but much more important, life within the internal market. My arguments all along in trying to understand this crisis are that it is a mistake to assume that this is a crisis of the euro. There are many countries outside the euro that have been caught up in this crisis, and that's because they all participate in the same capital market, in the same financial market, in the same internal market of the European Union, even when they're not European Union members themselves. Think of Iceland, for example. And so what we need to do is to recast the debate so that it's a much broader debate, bring in those countries from outside the Eurozone, and come up with a framework that will work for all countries in the European Union to establish a financial area that is stable despite the many shocks that we're likely to experience in the days and months and weeks to come. Okay, so if I'm going to make this argument about the need to move toward anti-fragility in a rule-based macroeconomic situation, then what I'm going to have to do is I'm going to have to posit 4 basic lines of analysis. Now, the first line of analysis is I have to explain why I think that Europe is based on a macroeconomic governance structure that's predicated on the predominance of rules over discretion. And in that context, I've got to introduce these concepts of rules and discretion so that we all know what we're talking about and we can be sure to communicate effectively. Then, the second thing I have to do is I have to explain why this rule-based framework doesn't seem to be that stable over time. So I'm going to have to introduce the idea that maybe we have an incomplete set of rules or an unstable set of rules and show what happens when these rules break down. Specifically, and this is the third thing, I have to look at the consequences of rule failure both at the domestic level and at the European level, so that we get a better sense of what is at stake if we don't move from the framework of macroeconomic governance that we have right now. And then fourth, I have to set out the case for making a less fragile set of institutions, so that if we cannot move away from a rule-based framework, and I believe fundamentally that we cannot, if we cannot move toward more discretion, then we've got to figure out some way to make the best of a bad situation. And there are a few proposals that I would like to offer at the end to suggest that how that might be moved forward. Okay, why does Europe prefer rules over discretion? This is the first part of the talk. And the answer actually comes from a question that was asked to me by the German Central Bank in the early 1990s. As a team of researchers, we were asked to examine how much political union we would need to construct in order to stabilize the single currency. And the answer that the German Bundesbank wanted, and so the answer ultimately that we delivered, was that the kind of political union you will need is a political union based on shared preferences rather than shared decision-making institutions. You see, what the Bundesbank was worried about, and quite understandably so, is that if we irrevocably fix exchange rates in order to eliminate exchange rate volatility within the context of capital market in financial market integration. If we irrevocably fix exchange rates, then implicitly we must also establish a common monetary policy for those countries that participate in the economic and monetary union. And that common monetary policy would be inherently political. It would be political in the sense that we know that changes in the setting of monetary policy instruments and changes in the strategy for setting monetary policy instruments can, but may not, it can influence the inflation-unemployment trade-off. And so if we want to make sure that we establish a common basis for understanding how changes in monetary policy instruments influence the inflation-unemployment trade-off, and if we don't want to politicize monetary policy in any meaningful way, then what we have to do is establish a rule-based framework for testing people to see whether they have the right preferences to engage in a common monetary policy regime. And this is what the convergence criteria for the Maastricht Treaty were all about. If you look at the convergence criteria for the Maastricht Treaty, there are essentially 5 criteria, 3 of which are tests for your ability to survive in a low inflation environment. One is a direct test that looks at your relative inflation performance. Another is an indirect test that looks at market evaluation of your future inflation performance. This is the long-term interest rate criterion. And the third is another direct test to look at your relative performance across countries. This is the exchange rate criterion. If we can get the markets to agree that you are as anti-inflation as everyone else, your exchange rates should be safe, that your commitment to low inflation is consistent over the long-term horizon, your long-term bond yields should be low, and your actual inflation performance is consistent with what everybody else is doing, then we can be sure that you can survive in a low inflationary environment. And then all we need to do in addition to that are establish rules to test you for your willingness to depoliticize monetary policy institutions, so you have to make your central bank politically independent, and your willingness not to allow fiscal policymakers to pull an end run in the macroeconomic framework. So we had 2 different measures for a single criterion, which was the excessive deficit criterion. Don't allow the difference between receipts and expenditures to have monetary consequences that would be destabilizing for the monetary union as a whole. Now within that context, we then began to elaborate an ever more comprehensive set of rules for ensuring that we maintained this low inflation macroeconomic policy framework. Now, the name for this is the Brussels-Frankfurt Consensus, a name that was introduced by a Belgian economist named Paul Krauwe. And the Brussels-Frankfurt Consensus basically says, look, we're going to have this low inflation macroeconomic policy framework. We're going to have stable fiscal policy. When we need to foster adjustment, the way we'll foster adjustment is not through fiscal stabilization across countries. There was no desire to create common fiscal institutions at the start of the 1990s. We don't want to have labor market mobility across countries either, although we respect the fact that labor market dynamics could provide a stabilizing mechanism. The reality is that from the time of the Delors white paper on jobs growth and competitiveness, the emphasis in Europe was always on establishing labor market flexibility at the local level so that we can have efficient local factor markets and we can adjust domestically. This is the origins of the market structural reform agenda that progresses and accelerates at the end of the 1990s and into the 2000s. Now within that context, we had a very strong rule-based framework that was actually strengthened by the October 1993 German Constitutional Court decision, which set as a precedent the idea that Europe cannot have discretion at the continental level because it doesn't have the kind of democratic legitimation that would be required for people to be represented in European institutions in anything like a democratic way. And so the October 1993 Bundesverfassungsgericht's decision says, in order to protect the relationship between the voter and their representative, we have to make sure that democracy focuses at the domestic level, and that parliamentarians are only allowed to delegate that authority over which they can predictably anticipate the consequences of their action. They can't delegate the authority for delegation. This is added on later in a subsequent German Constitutional Court decision. But at the time, they can't delegate authority over future uncertain states. And so the emphasis in the October 1993 decision was not to allow for automatic entry into economic and monetary union because there's no way that German politicians in 1991 or 1992 could anticipate what the conditions would be like in an economic and monetary union in 1996 or 1997. And And so there had to be further discretion exercised at the national level in that context. Now we all know the history of this. This is what evolved into the Stability Pact, which became the Stability Growth Pact, which emerged as the Lisbon Strategy, which effectively combines this emphasis on macroeconomic stability on the one hand and market structural reform on the other. And it's all rule-based and enforcement-based, with the idea being that we tell everybody what they're supposed to do, they have to do what we tell them, and if they don't do it, then bad things are going to happen to them as a consequence. Well, this is why the European framework is based on rules. There was not meant to be any discretion. As a matter of fact, the only institution that was given discretion was the European Central Bank, and it was specifically enjoined not only from not receiving instructions, but not engaging in any kind of political dialogue. And the member states themselves were enjoined in not engaging in any kind of political dialogue with the ECB. So the ECB's discretion was supposed to be purely technical in nature. It's a discretion that included the definition of its own target, which is this notion of price stability. Now, we're going to set aside that ECB discretion for a moment and focus on the rule-based framework. Because the question is, and this is the second part of the talk, what happens when the rules break down, right? Why is it that the rules don't function the way we would anticipate? And this, I think, is relatively easy to imagine, right? We're going to consider three different scenarios. One scenario is where a country is running a huge fiscal surplus, but the economy is nevertheless still overheating. And so then the question becomes, well, how do we get them to run a surplus that's even larger than the one they already have? Now, this is actually kind of a consideration that no one had thought about in the context of the excessive deficit procedure, or even in the broad economic policy guidelines that were to follow. It was never really considered as a possibility that a country would be overheating in the context of a surplus to GDP of about 4.7%, no, 4.2%. But that was the situation in Ireland in 2000, and so when the Irish Taoiseach came to the ECOFIN Council in the context of the broad economic policy guidelines, when the Irish Taoiseach came in to negotiate the broad economic policy guidelines for the following year, what he agreed was that he would actually increase the surplus to GDP ratio in the upcoming December budgetary talks, and he would do so in order to lower the pressure on the Irish economy, which was out of line with the developments elsewhere in the Eurozone. The problem is that the Taoiseach at the time, Bertie Ahern, reneged on that commitment, and in December of 2000 decided that instead of raising the surplus, he would actually reduce it ever so slightly, because he was going into elections the following March. And the ECOFIN Council then had no choice but to reprimand Ahern. It was supposed to be a secret reprimand in February of 2001, but Ahern immediately made the reprimand public and said, look, you guys are interfering with an economic situation where we're doing better than anyone else, we're paying off our debts, and yet you're telling us we have to do even more, and this is absurd. That was one type of situation that was never considered when we designed the rules for macroeconomic policy coordination. Another type of situation that was never considered was that Germany would get into trouble. You see, the whole emphasis on this rule-based framework was predicated on the idea that the German model for macroeconomic policy was the superior model. And within that context, designing rules to accommodate a Germany that failed to abide by the rules was never actually openly considered. And yet, nevertheless, in 2002, in February, we discovered, much to our dismay, that this was precisely the situation that Germany found itself in. Now, the initial reaction was to ignore the problem. So in February of 2002, rather than issuing an early warning against Germany, as they were supposed to do under the Stability and Growth Pact, the ECOFIN Council decided they would let Germany make a solemn commitment to get its deficit situation under control, and then they would hope for the best. Of course, this consideration could not just apply to Germany, because Portugal was coming up as well, and so Portugal was grandfathered into this unique arrangement, and it failed for both countries as they progressed through the year and economic conditions continued to worsen. Now, Portugal and Germany are two very different cases. One is a small open economy, Portugal, and the other is a large, relatively more closed economy, Germany. There's no case to be made for macroeconomic reflation on a Keynesian basis for Portugal, because we know that too much of the stimulus would bleed out in the consumption of imports. But in the case of Germany, there might be a serious argument to be made that Germany should engage in some kind of macroeconomic reflation, particularly in the kind of recession that Germany was experiencing in 2002. And indeed, the German government came around and started to make that case in the summer of that year. The problem is that the idea of creating an exception for one country and not an exception for another had never occurred to the designers of the rules. The idea that we might actually differentiate between countries in terms of the way the rules are meant to be enforced had never occurred to them either. And so the rule-based framework wasn't set up for this kind of flexibility, and indeed, even worse, there was no mechanism for introducing discretion over the implementation of the rules either. Now this all comes to a head in November of 2003 when the ECOFIN Council finally has to make the decision to make the procedures for macroeconomic policy coordination legally binding, not just on Germany, but also on France. And the procedure for making that decision is that you have to obtain a qualified majority to move the macroeconomic policy coordination mechanism from legally suggestive to legally binding, so that the failure to comply with the suggestions could actually be legally enforced. Well, they couldn't come up with a qualified majority, and there were no rules for handling a situation in the absence of a qualified majority either. So the ECOFIN Council in November of 2003 had to invent a whole new procedure, a procedure that the European Court of Justice ruled 6 months later was unlawful. They had to invent a whole new procedure in order to accept the recommendations but not make them legally enforceable. And the immediate implication of this was that, again, there was a differential treatment between the member states. Why were these large countries being exempted? Ironically, the most vocal opponent of this situation was the Netherlands, which is a small country that itself was about to be entered into the excessive deficit procedure. So the Netherlands said, wait, this is terrible. You can't do this. We want to join the European Commission in taking you to the European Court of Justice, you being the ECOFIN Council. And everybody looked at the Dutch and said, you guys are crazy. But from the small countries' standpoint, it actually makes sense because small countries can't use Keynesian reflation, and small countries have this problem of periodic country-specific liquidity crises. Should they run into trouble, they can see their bond markets evacuated. And so for the Dutch, it actually did make sense to try to enforce the rules, because enforcing the rules meant maintaining market access. For the Germans, again, it was open to question whether a Keynesian reflation might not have been more welcome. Now, this idea of the rules breaking down actually becomes even more significant in the context of the current crisis. If you look at the current crisis, there's obviously too much attention that's being focused on Greece, because the idea is that Greece didn't follow the rules for macroeconomic policy coordination, and this is what happens to you when you don't follow the rules. But Greece is the exception, not the norm. The norm in this crisis are countries like Spain and Ireland. These are countries that have made significant progress in macroeconomic policy coordination and significant progress in fiscal consolidation as well. If you think about the situation of the Irish, their debt to GDP ratio was about 27% in 2007. So investors should be forgiven if they bought Irish debt in 2007 when it was just 27% of GDP. Investors should be forgiven for thinking that this was a good bet, right? I mean, the Irish state was more than capable of paying that off. Of course, what they could not anticipate is that within a year, the Irish government would decide to underwrite the liabilities of the entire Irish banking system. And they underwrote the liabilities of the Irish banking system because of a flaw that was built into the design, not of Europe's single currency, but of Europe's integrated financial space. A design flaw that we had never anticipated in the context of capital market integration. A design flaw that made it absolutely essential for countries to underwrite their banking systems as a means of restoring confidence, because failure to do so would lead to an evacuation of the banking system, a country-specific liquidity crisis, and basically a downward death spiral for the economy as a whole. And what is this flaw, and why didn't we think about it? The flaw is something that I don't want to go into in great detail because I don't want to abuse the chairman in the time that I've been allotted, but it can be expressed very simply. The theorists who understood the creation of the single currency were using a theory that's called the literature on optimum currency areas. And the literature on optimum currency areas assumes that within a common currency, capital market flows are stabilizing and work in the interests of macroeconomic adjustment. Now, this was written into the seminal work by Robert Mundell in the early 1960s. Mundell's criterion for an optimal currency area was, in fact, the integration of factor markets, capital markets included. Fast forward to the Padua-Schioppa report in 1987, when they were completing the internal market and looked at the possibility that capital market integration would lead to unrealistically large flows of capital and speculative pressures, volatility in exchange rate markets. What Padua-Schioppa argued was, what we need is somehow better to coordinate exchange rates, and even as a first best solution, irrevocably to fix exchange rates, so that we can preserve not just the capital market integration that we want, but much more important, the goods and services market integration configuration that would be adversely affected by exchange rate volatility. So we need to have both of those things, and that's what monetary union was meant to provide. But no one ever thought that if we create a single currency to stabilize Europe's capital markets, we might in some way fundamentally transform the nature of European banking. As a matter of fact, banking was viewed within the ethos of the internal market. And in the Padua-Schioppa report, it is explicit that banking should be handled according to the same principles of mutual recognition that made the completion of internal market possible in the first place. Different countries should have different rules for different banks, and they should be accepted as viable across Europe as a whole. And countries should remain responsible for banking supervision. Now, as we go into the design of the single currency, this is going to be problematic. But it's problematic also for those countries outside, because what nobody seemed to anticipate was the fact that banks, both in rich countries and in poor countries, could rapidly grow beyond the capacity of those countries either to supervise them or to bail them out if they get into trouble. And as a consequence, as these banks morphed into giant bank assurance conglomerates that bestrode the world stage like Colossus, the countries found themselves in the unenviable situation that the Irish found themselves in. A situation where they had to put the solvency of the state at risk in order to protect the banking system. And unfortunately, by doing so, they created what economists have called a doom loop, where they undermine the creditworthiness of the sovereign to save the banks, and in doing so, undermine the value of the assets in which the banks are most heavily concentrated, being sovereign debt instruments. As a consequence, requiring even more bailouts for the banks and putting greater pressure on the sovereigns. Now, this design flaw is the third illustration of what happens when the rules go wrong, because we never imagined a situation in which a country could go from 27% of debt to GDP to 110% of debt to GDP in just 5 years. But that's the experience that Ireland has just had. And in that context, it's difficult to imagine how we could enforce the same rules for macroeconomic policy coordination. Well, what happens, and this is the third part of the talk, what happens when we try to enforce the rules even after the rules go bad? Well, I think that it's pretty obvious that what happens is bad things. Bad things happen in the context of European institutions, because as we try to enforce the rules, what we expose is the real power politics of European decision-making, particularly in the ECOFIN Council or the European Council writ large. Because large countries will be able to garner exceptions and small countries will not. Consider the situation of Ireland right now in the context of the bailout that it's given to its banks. One of the things that Ireland has been forced to accept is that none of the private sector creditors who had purchased bank bonds in Ireland can be forced to apply a haircut. And so the Irish state and the Irish citizenry are caught on the hook for the liabilities of the banking system as a whole. And consistently, time and again, as they've asked for exemptions to be made on their behalf, they've been told that that would violate the rules of the game, and there's no way that this kind of an exemption can be tolerated. Well, for the Irish, this is understandably uncomfortable, and it seems to smack of an inconsistency of treatment from one part of the euro system to the next. There are other elements where this becomes problematic. Consider the situation with emergency liquidity assistance. Now, all of you know that emergency liquidity assistance is the great exception in the monetary policy framework. When banks run out of the possibility to get access to sufficient credit to maintain routine operations from the European system of central banks, there is an escape clause that allows them to use substandard collateral to get liquidity from their national banking system. This is emergency liquidity assistance. In effect, it's liquidity that's created not at the European level, but at the national level. It's liquidity created at the national level using different standards for collateral, and in many respects outside of the control of the euro system as a whole. And the more that national banks engage in emergency liquidity assistance and liquidity creation at the national level, the more the governing council of the European Central Bank must necessarily become concerned about the loss of control over liquidity creation across the euro system. And the Irish have come under consistent pressure to limit emergency liquidity assistance. The Spanish have come under consistent pressure to limit emergency liquidity assistance as well, and the Greek banking system almost exclusively survives on the basis of emergency liquidity assistance. If the ECB were to try to cut that off, there would be only one choice for the Greek government. That would be the choice between its money and its banks. And we can only imagine that they would choose to leave the Eurozone rather than watch their entire domestic banking system go bankrupt. Now, within that context, what we could argue is that at the European level, it's dangerous for us to see the rules break down, but it's even more dangerous at the national level, because this is where the populist reaction to European institutions comes from. When the public views the rules being applied at the European level as either unreasonable or inconsistent, it's not unreasonable for populist politicians who want to seek office to begin mobilizing against those rules. Now, mobilization against the unreasonableness of rules is what we've been seeing in Greece, and it culminated last May in the 2 rounds of national elections that finally resulted in a stable Greek government, but may not have. And indeed, if this current coalition were to fall, the kind of populist mobilization against what they view as unreasonable requirements for conditionality of European assistance, this kind of mobilization against it, could lead to a Greek domestic political situation that would be dynamically unstable. The inconsistency argument is what we see actually in the northern European states. This is where people are actually lobbying, saying, well, wait a minute, there are all these rules, but you seem to be letting the southern peripheral countries escape from the rules and do things that are wrong. Even in the Dutch context, and the Dutch Prime Minister right now has recently come out against Barroso's proposals. In the Dutch context, they're saying we have to all abide by the rules. And if that means imposing ever tougher conditions on the Greeks, then so be it. Well, the tension between these two things is pretty awful, because either you accept the populist discourse in the northern European countries that it forces us to apply the rules come what may, or you accept the populist discourse in the southern European countries that says, look, we need exceptions to the rules come what may. And you can't have it both ways, unfortunately. And there is a third option, which is what has resulted, right? Because in the context of these two competing forces, we get the pattern of decision-making at the European level that looks like muddling through, as we try to accommodate the needs of the southern European countries while at the same time imposing the discipline that the northern European countries demand. But muddling through is not a solution to the crisis. And so what is happening is that all of the political discretion is being shifted from the ECOFIN Council and the European Council onto the one institution at the European level where discretion was always allowed. It just wasn't supposed to be political. That's the European Central Bank. And what we've seen progressing time and again throughout this crisis is that the European Central Bank has had to exercise its discretion in order to buy time for decision-making in other European institutions, decision-making that still hasn't come about in any decisive fashion. And so, for example, we saw at the start of the crisis the European Central Bank begin to experiment with different forms of liquidity provision, providing term-length liquidity to stabilize the European banking system. The European Central Bank then began to manipulate its own collateral rules in order to ensure that there would be adequate supplies of collateral, not just across the Eurozone as a whole, but particularly in those countries experiencing distress. The European Central Bank exercised discretion to buy distressed sovereign debt instruments in secondary markets under the Securities Markets Program. And then the European Central Bank exercised its discretion to provide unlimited amounts of liquidity up to a 3-year term with the LTROs. And each time it has applied this discretion, it's become more and more controversial. We've seen the German Bundesbank president Axel Weber complain viciously about the Stability or Securities Markets Program. We've seen another German member of the ECB Executive Board, Jürgen Stark, be very upset, not just about the Securities Markets Program, but also about the manipulation of collateral rules. The LTRO has been criticized because of the extent to which it's injected liquidity into the Eurozone economy, but most critical of all has been the most recent act of discretion by the President of the European Central Bank, Mario Draghi, in his 26 July speech in London. And this is something I want you to focus on. Mario Draghi came out to the financial community in London and he said something that was, in many respects, unexpected. He said, I will do whatever I can within my power to ensure that the internal financial market, the European financial space, remains whole. It's not a question of safeguarding the euro. He does say he'll safeguard the euro, but much more important is safeguarding the integration of the European financial markets. Now imagine any other European leader being able to make a similar assertion. Imagine Lady Cathy Ashton coming out and saying, I will do anything in my power to ensure that Syria returns to peace. That kind of a pronouncement from Lady Ashton is almost inconceivable. There is no other actor at the European level who could exercise such discretion. Now, admittedly, the European Central Bank president could only exercise that discretion with the support of his board. He could only exercise that discretion with the support of the significant member states as well. And it was an important act of leadership by the German chancellor to change her position from March of 2010 in September of 2012 to ensure that Mario Draghi and this new outright monetary transactions program could work. But the end result is that this one institution that's capable of exercising discretion has become obviously and overtly political. The idea that the European Central Bank is somehow politically independent is now no longer credible. It is a political institution because it makes decisions that affect the distribution of income across the member states and within the member states for Europe as a whole. If we don't recognize the political nature of this transformation, then I think we're deluding ourselves into believing that the ECB is somehow outside politics, and we're underestimating the extent to which it could be politicized in ways that we would like to avoid. Unfortunately, what's going to happen is that we're not going to move toward a framework where we can push decision-making back into a more legitimate political arena. We're not going to end up in a situation where the ECOFIN Council takes pressure off of the ECB and accepts responsibility for managing the crisis instead. On the contrary, what we're seeing in the context of Barroso's proposals is a real emphasis, again, on the nature of the rules, the pattern of enforcement, and the necessity for other supranational institutions to reinforce the member states in making decisions they should have made themselves at the national level. This leaves the ECB isolated and at risk. How could we get this situation to be transformed? Well, this is what resilience is about. If we're going to insist on having a rule-based framework, and this is the fourth part of the talk, if we're going to insist on having a rule-based framework, then we have to have a framework that is resilient enough to accommodate unforeseen situations like governments that need to run even larger surpluses, unforeseen situations like governments that should be exempted and allowed to run ever larger deficits, but much more important, unforeseen situations that arise from the design flaw in European integrated capital markets, which is to say the internal market for Europe as a whole. This design flaw is problematic, and that's where I'm going to focus my attention. The design flaw is problematic because it creates a significant difference between Europe and the United States. A lot of people argue that the difference between Europe and the United States is in the design of federal fiscal institutions. That is not true. I would be happy to show you data that shows that U.S. federal fiscal institutions, because they are geared through matching resources at the state level in the United States, actually tend to exacerbate rather than mitigate income performance at the regional level. This is very easily demonstrated, and it runs completely counter to the intuition that we should see some federal fiscal stabilization in the United States. That's not what happens at all. Most of the stabilization that takes place in the United States takes place through the exercise of discretionary fiscal policy, something that would never be possible at the European Union level. If we can't agree on a budget that's worth 1% of gross national income, then it's unlikely we'll ever agree on a budget that's much larger. Having said that, the point is that the distinction between Europe and the United States is not in the design of fiscal institutions, it's in the reaction of market participants in the financial community. In the United States, when market participants become afraid, they have a standard pattern of the flight to quality. They sell equity and they buy fixed income, which is to say they move from stocks to bonds. And they move up the fixed income ladder, selling ever riskier assets and buying ever safer assets until they reach the pinnacle of risk-free asset class, which is U.S. government securities, securities that circulate easily across the United States as a whole, and in which every bank specializes for its banking book activities. In other words, all routine financial operations use these securities as well. Now, the situation is so perverse in the United States that when Standard & Poor's decided to downgrade the US administration in August of last year, because the US administration could not agree to renew its debt ceiling, the reaction in financial markets to the downgrade was to bid up the price of government bonds and to bid down the yields. Why? Because everybody got afraid about what was going to happen to the US economy as a whole, and when they get afraid about what's going to happen to the US economy as a whole, they buy US Treasury certificates. Having said that, in Europe, it doesn't work that way. It starts the same, with people selling equity to buy fixed income, but as they climb up the fixed income quality ladder, they find different peaks in different countries. And it's a very easy thing for banks from one country to the next to look across Europe's integrated financial space and to say, you know what, my risk-free asset is not as risk-free as your risk-free asset, and so I'm going to sell my risk-free asset to buy yours. Now, the apotheosis of this is what happened in Italy in July of 2011. You see, in Italy in July of 2011, up to that point and throughout its participation in Europe's economic and monetary union, the Italian central bank was a net creditor to the underlying financial architecture of the euro system. It was a net creditor to Target 2. But in July, it ceased to be a net creditor to Target 2. And over the course of the next 12 months, it became a net debtor to the tune of over 350 billion euros. Why did this happen? Well, it happens because the Target 2 system is actually the grease that accommodates any friction between movements in the capital account and movements in the current account. If capital flows out of the country but trade patterns remain the same, then the gap between current account performance and capital account performance on the balance of payments has to be financed somehow. And in the euro system, it's financed through the extension of credit from the euro system as a whole to the national central bank of the country that's exposed. So what we saw in Italy in July of 2011 was a sudden conversion of its securities markets and the market for Italian government certificates specifically, a sudden conversion from a net investment opportunity to a net liquidation market, and the liquidation of Italian debt securities succeeded in driving the government out of office by the following November. Now, we managed to stabilize the situation, but that doesn't mean the situation is stable over the long run, because we worry consistently in the context of Italy that a further flight to quality would drive even more investors out of the Italian debt market and precipitate yet another crisis. And there is no mechanism that exists to stop that. Even the outright monetary transactions cannot stop that if it becomes too extreme. Because although Mario Draghi said that they will buy unlimited amounts of debt at maturities of less than 2 years, unlimited is not infinite. Unlimited means they don't announce the limits. But we know that there are limits in the amount that the European Central Bank can purchase. Those limits are implied by the politics of the governing council and by the willingness, and specifically of the German Bundesbank, to tolerate the accumulation of that debt on the ECB's balance sheet. Once that limit is reached, the markets will begin to speculate against Italy and the crisis will renew in force. So how do we get out of that dilemma? Well, systems theory tells us that what you need to do, if you have a complex system that's subject to these volatile flows, what you need to do is build large reservoirs so that you can accumulate these flows and allow them to stabilize the system. Now, the way you build these large reservoirs to accumulate the flows is you create a single risk-free asset class that's capable of holding all of the fear in the European marketplace. The German government bond market is clearly inadequate to the task. It's inadequate because it was paying negative yield, not just in real terms at the long end of the spectrum, but in nominal terms at the short end of the spectrum during the heights of the crisis. So it's obviously not large enough to hold the flight to quality in Europe. We need some asset class that's even larger than that would be risk-free. And the easiest way to construct that reservoir would be to combine the responsible borrowing of all European countries into one asset that would trade equally. It could be used for banking operations across the European internal market as a whole. Now, this single asset would be for responsible borrowing and would create a firewall between what's responsible and what is not, but it should be large enough to hold all of the fear in the European marketplace. That's what the Eurobond proposal that was announced by the Bruegel Institute in March 2010 was all about. And that's how this Eurobond proposal could help us. Rather than bailing out countries. The goal is to stabilize the capital market situation, to sever the link between banks and sovereigns, and to make the European financial space more resilient so that we can allow governments to go bankrupt on their irresponsible borrowing above a threshold. The Bruegel proposal is 60% of GDP. But we should allow governments to go bankrupt on their irresponsible borrowing, and we should tell investors that that irresponsible borrowing is much riskier than the responsible borrowing in the market, so that investors will charge them a premium as well. In doing so, create a market incentive to keep macroeconomic policy in check. Now, all of this stuff is not about redistributing from north to south, and it's not about creating moral hazard. Far from it. It's about keeping the rule-based system that we have and allowing that rule-based system to be more resilient in the face of unforeseen macroeconomic shocks, the kinds of shocks that create fear in the markets. Because if we can make it more resilient, then we won't have to worry about decisiveness at the European level. We can allow for muddling through because we won't have these intense moments of crisis. Unfortunately, that's not what the Barroso proposal offers. What the Barroso proposal offers, far from creating a receptacle for fear, is a Euro bill facility that would allow us directly to bail out the sovereign debt of those distressed countries, even if it's a redemption fund above what we consider to be responsible levels of borrowing. This looks inherently political, and I'll leave you with a final thought. Does this kind of transfer offer any real sense of resilience? Look at the situation in Catalonia, look at the situation in Flanders, look at the situation in Scotland. Even in unitary states, it is easy to imagine conflicts, existential conflicts, over the distribution of fiscal resources. Even in unitary states with a long history of living together, those conflicts can become the focal point for political contestation that would lead to crises, like the one we had in Belgium, that are unprecedented in nature. Do we really want to elevate political conflicts of that sort to the European level? Again, we can't agree on a budget for 1% of gross national income. What is the likelihood that we would have a resilient European Union if we increased the budget much beyond that and made transfers across countries much more transparent? Thank you very much.
Thank you very much, Eric. The idea of how this roundtable discussion works is that this was the appetizer. We now have a very short, risk-free, hopefully risk-free coffee break. And then we reconvene for the discussion, actually. Of course, the first round discussion will be introduced by two of our guests, Agnes Stern and already did. But before we do this, I invite you for a very short coffee break. It's more an espresso